afternoon, everybody. What we're talking about today, or what I'm talking about today, is copper supply. Copper, as you've probably heard in some of the various talks and presentations here at VRIC 2026, key to electrification, power demand, and all things like that. There's a big supply deficit coming, and I'm going to share with you my sort of thoughts and views on some of the things related to that. Who am I? I'm Paul Harris. I'm the mining anchor for Kitco Mining. I'm the America's editor for Mining Journal, and I also help Rick Rule produce his Rule Investment newsletter. And this is Rick Rule's Substack. The information I'm sort of going to present to you today, we're going to put out in a more of a long-form written piece with more sort of data and details in. That's going to be in the next Substack issue, which will come out in February. So if you want to receive that, subscribe to the Substack at Real Rick Rule. Jay Martin invited me to this event to talk about copper a couple of years ago, and this is one of the charts I included in that presentation. Back then, the copper price was hanging in, or well, not hanging in, was pretty sort of stable at around $4 per pound. And so back then I was talking about a lot of the things that are still very present in the space and that I'm going to go into in a bit more detail later on. Hopefully you saw this presentation back then and positioned into copper and copper stocks and would have benefited from this run up in prices to $6 per pound. If you didn't, the good news is that the $7 and $8 per pound figures that I've sort of scrawled into this chart, that's still very much on the horizon and potentially more. Electricity demand is only going to increase. Reports put out, or estimations put out, forecasts put out 169% growth by 2050. Increasing electricity demand needs copper to get the electricity to where people want to use it. The chart on the right here, this shows sort of power consumption or energy consumption by the wealth of countries. And as it says, there are no energy poor rich countries. So as the GDP per capita of countries increases, and there's some very big countries moving up this chart, Indonesia, India, Brazil, for example, their power consumption is going to increase. They're going to want the fridges, air conditioners, all mod cons that we enjoy, and they all require copper in the actual products themselves, but obviously for the electricity that will power them. Why is the copper price going to go higher? This chart talks about or shows the copper supply deficit that's just starting to be experienced in the market. The global copper market or production is about sort of 25 million tons per year. That's forecast to grow up to sort of 45 to 50 million tons per year by 2050. But the mine response is very limited and muted for various reasons, which I'm going to go into. S&P forecasts a production peak of 33 million tons per year of copper in 2030. And so the forecast is for a supply gap of almost 10 million tons per year opening by the end of the decade. And that sort of 10 million tons is approximately 20 to 40% of current world supply. So let's look at the supply response. Now, supply response, there's many factors, and I'll go into several of those. Mining is a challenging business. There's always something that can go wrong, and that's something that companies prepare for and expect the unexpected. And this is an example, what you're seeing here, of what can happen. This is the production chart from, I think, about Grasberg, Freeport-McMoRan's Grasberg, which suffered an incident this year, which took production down for quite a while, and that puts a big dent in the production profile. We saw similar things at Codelco's El Teniente this year. They had a technical incident that took out some production. And of course, Robert Friedland's Ivanhoe Mines at Kamoa-Kakula, they had an incident, a technical incident, which again took out some production. So in any given year, The copper analysts forecast that 5% of mine supply will be offline for whatever reason, whether that's a technical incident, such as we see here, or strikes or other things. Outages are relatively common, and of course, they all add up to supply stress, and when they happen, their potential to spike copper prices is quite significant. For those of you who can think back to the copper super cycle that ran from about 2003 to 2008, when things started really heating up, any potential disruption or rumor of potential disruption would spike the copper price up to sort of $4.50 a pound. What are some of the other factors in the copper supply deficit scenario? Exploration is hard. Exploration is expensive. Exploration is time-consuming. It takes an estimated 20 to 30 years to discover a copper deposit, to work it up, to permit it, to build it, and then bring it into production. So any new discovery today, I see a couple of copper exploration geologists in the audience, any new discovery they make today will perhaps mean copper supply for their grandchildren. Supply is relatively inelastic, and in that sense, it doesn't really matter what the copper price does. Mine supply cannot be increased quickly. And that obviously gives the copper price a lot of potential to run higher. Now, what are some of the things we can see in the chart I've got before you? To the left, copper mines are getting older, which means it's getting more expensive to mine the copper, and it also means head grade is declining. The chart on the right shows how the average copper production grade has declined over time. It's fallen by 40% over the past 25 years. The average production grade in Chilean copper mines is about 0.45% copper today. This chart shows, as I say, a 40% decline between 91 and 2024. The industry's response to the grade question has been to supersize operations. A number of big copper mines have what they call expansion projects underway, and these are putting in the infrastructure to take daily throughput from, let's say, 100,000 tons per day to 200 to 300 to even 400,000 tons a day. That's a lot of rock to move, and it's very costly to do. But it's having that volume that generates the economies of scale that enables them to continue to operate. Exploration is hard, which is why fewer discoveries are being made. This chart shows a number of the major discoveries over the past 20 or 30 years. And in addition to the fact that you can see the number of them, the frequency of them is falling, the other thing you'll notice, and this is a chart that was produced by BHP, one of the world's largest mining companies, you can see that the discoveries are getting deeper. This axis is depth. The discoveries are getting deeper, which means the mines that will eventually be built at these projects will require more infrastructure, more capital investment, which leads to longer development times and greater risk. And risk is a key factor, which we'll be talking about a little bit later on. These factors are also why we don't see a lot of small copper companies. Junior developers may be able to take a gold deposit into production. They really don't have the bandwidth, the financial capability, or the technical ability to bring new copper deposits into production. There are a number of copper developers that do have projects that will come into production, and they tend to be near surface, nearer the coast. They have a lower infrastructure requirement and don't have so much of a depth requirement to deal with. Because copper exploration is a difficult proposition for non-cash flowing junior explorers, there are few juniors that hold large development stage copper projects. On this slide, it's a couple of years out of date. There's 8 projects highlighted which are in the hands or were in the hands of juniors. As you can see, most of the development stage projects are already in the hands of majors. A couple of the projects that highlighted in this slide are already subject to acquisitions. Cascabel, which is SolGold, and Cañariaco, they're both subject to transactions that are ongoing as we speak. So copper juniors that do have large deposits are very rare and very valuable, and eventually they will be acquired. Here at this conference, stand a couple of rows over, Regulus Resources, Aldebaran Resources, they've both got good-sized copper projects, and I would expect that at some point they will be subject to M&A transactions as well. Now, getting back to the copper supply deficit, why? The capital intensity to build a copper project is increasing because the deposits are getting deeper, because the grade is falling, because development of a copper mine requires much more capital investment. The costs are increasing. And this slide represents the cost per ton of installed capacity. The average today is about $20,000 to $25,000 per ton of installed capacity. You can see there's quite some variation there. Any project that's got a sub $20,000 per ton capital intensity is looking pretty good. This is one of the reasons why the copper majors are hesitant to build new mines, because costs are getting higher, and there have been recent examples of costs spiraling out of control. Teck Resources Quebrada Blanca 2 expansion project is very much a case in point. The capex required for that grew from, I think, around $3 billion when they were originally talking about it. When it finally came on stream, I think they'd spent or invested more than $8 billion. Nobody wants to repeat that, which is why the risks are getting higher. It's why boards and managements are really sort of staying their hands on green-lighting new investments. And when you consider that to build a new copper mine takes 2, 3 or 4 years, that's a lot of risk to be exposed to for a long period of time. And this is one of the drivers for some of the big mergers between the diversifiers that we're seeing at the moment. So, for example, Anglo American and Teck Resources buying up, getting together, that will result in a company with a $53 billion market capitalization. Building a $5 billion project when you've got a market capitalization $53 billion is an easier and more digestible proposition than doing it if you're a $20 billion company. There's talk of some other mergers as well that are equally large, such as Rio Tinto and Glencore. That's potentially a $200 billion company. Getting that scale will give those companies a lower cost of capital. It will ease back one of the risk factors, and obviously that risk can be spread over a much bigger portfolio. And these risk factors, these cost factors, are why that despite the fact copper prices are at record levels, we're not seeing a lot of new mines being built or mine builds being sanctioned. Even though the projects at this price level may be very, very profitable, the diversified miners typically look for a 15% hurdle rate to make new investments. At $6 per pound, many copper projects are sort of 20, 30, 40% IRRs. McEwen Copper's Los Azules, I think at spot prices, has a 70% IRR, which is quite amazing for a base metals project. But despite that, the risks are such that projects are not being green-lighted, which suggests that $6 per pound is not a high enough price to incentivize new projects. And that means the supply deficit is going to get worse. The copper price will still has a lot of potential to increase to get to that level where companies are confident and comfortable making multi-billion-dollar investment decisions. This slide is a little out of date as well, but it covers what I've just been talking about. This slide was originally created by Solaris Resources, which has a large copper development project in Ecuador called Warintza. And you can see it's on this axis, we have the sort of copper intensity per ton and the copper price, and how the IRRs vary according to different prices. Obviously, this goes up to $5 a pound. We're beyond this, but it gives you an indication of some base information or basic information that goes into some of the decisions that the companies have to make. And of course, remember, a copper company's purpose is to make money for its shareholders. It's not necessarily to provide the copper that society needs. So I've mentioned there's a couple of big transactions underway, M&A transactions underway. This is a slide from Benchmark Minerals Intelligence, and it focuses on Anglo-Teck, which would be the product of Anglo-American merging or buying Teck Resources, and it highlights the fact how increasingly going forward scale is a critical factor, both in terms of, as I mentioned, to access to capital, cost of capital, and the ability to absorb a large, or not absorb, but to be able to undertake multi-billion-dollar capital deployments. This also shows that the pool of companies that are ready, willing, and available to buy the smaller companies is shrinking. Now, as I mentioned, the data and the narrative behind the slides I've been talking about, Rick Rule and I are going to publish in about a month's time, so sign up for our Substack, or Rick Substack at Real Rick Rule, to get all of that, and thank you very much.